Good afternoon and welcome to the 654th meeting of the Economic Club of New York. I'm Barbara Ben Allen, President and CEO of the club, and it's an honor to be here with all of you in our 115th year. I also want to welcome we have over 100 people online today as well, so welcome to them. Throughout its history, the club has served as the preeminent nonpartisan forum for discussions on social, economic, and political issues, and that continues obviously up through today. I want to also just take a moment before we get started with our program to welcome our ECNY 2022 class of fellows, some of which are here, a select group of diverse, rising next-gen thought leaders. We also have some students online from CUNY Graduate Center and Fordham University. So welcome. Today, I'm honored to welcome the President and CEO of the Federal Reserve Bank of Chicago, Charlie Evans. Before becoming president in September of 2007, he served as Director of Research and Senior Vice President supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. His personal research has focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and financial market prices, and he has been published in peer-reviewed journals. Charlie's active in the civic community. He's a trustee at Rush University Medical Center. He's a director of the Chicago Council on Global Affairs, a member of the Economic Club of Chicago Board of Directors, which this club is quite close to, and a member of the Civic Committee of the Commercial Club of Chicago and the Civic Consulting Alliance Board. Charlie has taught at the University of Chicago, the University of Michigan, and the University of South Carolina. He received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University in Pittsburgh. The format today will be a conversation, and we're very fortunate to have club member Jan Hatzius, chief economist and head of global investment research at Goldman Sachs, doing the honors. As a reminder, this conversation is on the record. We have media both in the room and online. And now, without further ado, we will turn the mic over to both of you. Thank you.
Thanks so much, Barbara. Really wonderful, great honor to get the opportunity to have this conversation. And thanks also to the Economic Club of New York for setting up this great event. I think it's a good way to talk about all the many macro issues that keep all of us very occupied, many of us in the room very engaged. So I want to jump in really with the outlook for the economy, the outlook for growth. If you look at the March FOMC meeting, wasn't that long ago, there was a downward revision for many participants in terms of their growth outlook for this year. 2022 came down on a fourth quarter basis from 4% in December to 2.8% as of March. And 2.8% though is still a percentage point above the economy's potential. So still a pretty strong growth outlook. Now we've had quite a lot of information since then. And I'm curious, where do you stand relative to that kind of median view of the committee?
Well, thanks, John. And it's great to be here in New York, for this, very important eminent club. In terms of the U.S. economy, I think the fundamentals for the economy continue to be, relatively strong. I'm pretty comfortable with the median forecast that you just laid out there. In fact, when the summary of economic projections were put out there, most of my own projections were pretty close to the median, if not the median. I think, for the U.S. economy, we had probably, many of us thought that this year would be a stronger growth year, but we've seen some unevenness over time. I think the uneven effects of the Omicron, virus, transitory, relatively minor, Delta, in terms of the employment reports that we saw last year, they were initially released as pretty uneven, some of them very strong, then a few weaker. And then when the data revisions came out, it was kind of pretty smooth, strong throughout. And so I think that the current forecast of 2.8%, it's above potential, but we're still sort of recovering and doing quite well. Labor markets are doing well. The unemployment rate is close to 3.5%. And, consumers are probably in about as good a financial condition as they've ever been, partly through fiscal support for the low and moderate income households, and just also wage income has been good too. So there's good reason to expect this will continue, through this year into the next, and even in a rising rate environment. I think that the US economy should do, very well. Now, inflation is high, and that's really the challenge that we have before us. But I know we're going to talk about that in just a few minutes.
We're going to talk about that, and that obviously is important, very important in its own right, but it's also important for the growth outlook because it does have some implications for one of the aspects that you just mentioned, namely strong real income. And I think that's certainly very visible in terms of levels. And certainly if you take kind of a cumulative approach to this, but in terms of the growth rate of real income in 2022, that does look somewhat weaker with the high inflation eating into wage gains, and also, of course, the fiscal sort of step back. And I guess I'm curious how you're thinking about that in the context of an above potential growth outlook.
We're in the middle of a highly interesting, pretty vibrant, unusual labor market setting where workers are being called to come back to the office if they had been working remotely. Many essential workers, manufacturers, employees have been working on site for a long time, but they've been working very hard. One reason why businesses might have trouble finding workers is because they're opening third shifts that aren't normally open in order to meet goods demand. And there's a cyclicality to that. And workers are probably wondering, well, if I take that job, how long is it going to be around, and things like that. So there are many opportunities which are leading to strong employment opportunities for anybody who's willing to look, for those jobs. Wage increases for many of them, especially at the lower end of the income spectrum, right? If you were under $15 an hour, where an increase in the minimum wage to 15 might have been meaningful, many jobs have just sort of blown right through that, and they have higher wages. So now you get to the harder part of real income and how it's growing, and the inflation price increases that we're seeing certainly erode those gains. Some of that is high gas prices, all kinds of things which, might work themselves out over time, but there could be continued wage pressures for many people. This is a period where I think there's going to be a lot of still searching around for what the right wage levels are and whether or not workers are willing to move around in order to take advantage of that. One thing that I struggle with so much, as economists and at the, more elementary courses that, get taught, the thing that equilibrates labor demand and labor supply is the wage. And for workers who are really in a spot labor environment where they're willing to move around, you would expect, even with these price increases, that the spot wage ought to increase in order to clear the market, especially in an environment where demand for labor is so high. So I think it's still to be seen how it works out, the real income gains, and how that really is affected by the price increases that we've seen so much. But we, need to be mindful of a wage price spiral that takes hold, and that would be one of the things to monitor.
That's a great segue to the next question I was going to ask, namely the supply-demand imbalance in the labor market. If you just focus on the number of open positions versus the number of unemployed workers, 11 million open positions, 6 million, just under 6 million unemployed workers. That 5 million gap is the biggest that we've had going back to the 1950s, if you are willing to extend some of these series back.
Help wanted.
Whether in absolute terms or relative to the size of the population or the size of the labor force. So I guess my question is, how concerned are you about that imbalance? Obviously, we want a strong labor market, but is this too much of a good thing? Is the labor market very overheated in your view? Would that be an accurate description? And do you think that gap needs to close? And if so, how is it going to close? A lot of questions there.
There are. As I mentioned earlier, it's a vibrant labor market. So, workers looking for, gainful employment often have many opportunities. Professionals working in office settings, they have even more opportunities, right? Where am I going to work, right? I might even be able to work for the same employer, but I might not be working in Chicago or New York. I could be working in Florida or someplace like that. So there are a lot of challenges there. Now, if you're talking about job openings, there's sort of this it's almost cyclical that in environments like this, you have lots of job openings. Sometimes you have duplicate openings that are posted because they're really looking, for workers. So they advertise in multiple places, and that can get counted in that regard. I think as I get this question more, I should be utilizing my staff on this. It's kind of like these openings are at what wage setting? Is it one that the firm wants to offer? Is it one that the workers are going to take them up on? And so you have lots of openings at very low wages, relatively speaking, and not so many when wages go up. Or remote work is part of it, right? How many people have been heard from their recruiters, and it's kind of like I've been looking for IT professionals and such, and somewhere along the line very quickly they ask, can this be a remote only job? And if the answer is no, usually ends the interview pretty quickly, that type of thing. So there are many things going on. I won't be surprised if part of the gap is closed by openings just being withdrawn, so to speak, and not filled. I do expect people to come into the labor force and take those jobs up. And I think it'll be a lot of rematching too. And that's not exactly embodied in these numbers, right? It's just people at existing firms who are looking for different opportunities. And maybe they'll find them with, a similar firm, but is more open to that kind of remote work. One thing that I think is really challenging in this, you can almost convince yourself, if you're a manager and you've always liked to have your employees in front of you because that's how you manage, but workers, we've learned that we can meet our business objectives from home, at least at the Federal Reserve Bank of Chicago. I think we've been pretty successful in that regard. You could kind of convince yourself that people just wake up and decided they wanted to work remotely. Or is it the case that there's been a large percentage of people who always asked if they could work remotely, but they always got the answer back, no, we can't be done. Just don't know how to do it. Just would love to. And they heard that from other employers. The one thing about the last 2 years is we demonstrated that technology exists. We've been able to make that work. So you can't just say that can't be done. You have to give other answers. And then other firms are finding different ways to do it. I think the labor market is going to really evolve a lot over the next, many years. And it's going to be a challenge for a lot of business models.
Thank you. Moving on to more squarely on the inflation outlook and the recent information, we've gotten some, I would say, mixed information on the inflation numbers. If you look at last week's data, the core CPI came in below expectations for the first time since August, with more weakness in some of the goods categories that had driven a lot of the increase. Also, somewhat encouraging rent numbers, rent and owner's equivalent rent numbers. But at the same time, we're seeing more concern probably about supply chain disruptions picking up again in the wake of what's going on in China, in the wake of what's going on in Russia and Ukraine. And the labor market data continue to be very firm. So to the extent that you think the inflation process is really by what happens in the labor market to a large extent, you'd probably be more concerned than you were. Where do you fall out? Where do you see the sort of incremental information on the inflation outlook? Are you still revising up your inflation numbers, or do you think that process has now come to an end?
Well, that's a good question. I think, first off, I think the issue that you're alluding to is a very important one. I think it's a little bit further down in the pecking order of concerns. First concern is just inflation is very high. Last month it was, 7.9% on CPI. Now it's 8.5%. But of course, looking at the composition you can take note of some positive developments if they persist in that regard. Monetary policy, I know we'll talk more explicitly about that, but we're still at the very low, what some of my colleagues have referred to as an emergency setting for the funds rate. And so we're moving to adjust that to at least toward neutral, and then we'll see. And so we need to respond there. It's still too early, to be thinking that the inflation challenges that we're facing now are changing importantly, but we need to take note of that, and they could be. I think the most recent, inflation just sort of leaped up very quickly. The February, that's the report that I paid most attention to, even though we got new data just the other day, for the CPI came in at 7.9%, February 2020. What's striking about that report is the column right next to it, February 2021. Previous 12 months were 1.7% for CPI and 1.3% for core CPI. We'd gone through this long period of, below 2% inflation. After the great financial crisis, we kind of got up to 2%, and then it kind of eased off a little bit. Then COVID hit, and most recently it had been low, and then all of a sudden it leaped up. And there were some important microeconomic reasons, industry reasons why that happened. Used car prices went up 10%, 7% the next month, and 10% the month after that. They've gone up 40%. And there are a whole bunch of industry reasons in terms of supply chains, semiconductor chip shortages. There are not enough new cars on the lots. And so people might even, make an offer on, my daughter's, 2007 Toyota Corolla that she handed back to me some years ago. It might have some value. And so I think that's going to come down. And that's a little part of what is in that positive good news. It's also the case, though, that home furnishings have increased quite a lot, and hotel motel. I asked my colleagues, my staff, when people say the Fed let inflation get away from them, and I see all of these, microeconomic reasons why it went up. And it's like, can we cut the data in a way that might sort of separate these? And you can cut the ones that I just mentioned: vehicle prices, home furnishings, and motel, hotel. And that bucket is about 15% of the core CPI bucket. That went up 20% as of the February CPI, 20%. And a lot of it was vehicles. The remaining 85% was up 4.1%. Now, 4.1% is a big number, right? So that's something that we need to be paying attention to. But that component that leaped up, if it does a turnaround, first off, if it stops going up, that's a zero contribution. And if it does turn around, then it's going to be adding, nicely to reductions in CPI. So I think there's this sort of two-part aspect where you've got the goods part, which could do a little round tripping, and that would reduce inflation some. And then we got to get our arms around how much this is sort of broadened out to the rest of the basket. And that's true monetary policy, looking at that. And we're just going to have to be looking at that very, very carefully for quite some time. And the story I just told could change pretty quickly.
That's another great segue to what are you going to do about it? about the 80% of the basket. I mean, growing 4%. The unemployment rate's at 3.6. The estimate, at least in the SEP, for the longer term unemployment rate is a little above that. So, you are beyond the goal or long-term natural rate estimates that you've laid out. But you talked about policy moving back to neutral. Wouldn't this be an environment in which you should be clearly above neutral, or at least intend to get there pretty quick? Why is that? Why are you saying neutral? Why are you not saying well above neutral?
Well, because this is going to be a journey. We're at zero, or we're 25 basis points off zero, and let me just say, one estimate, the SEP for neutral nominal federal funds rate is 2.25 to 2.5. We got 200 basis points, just to get neutral. And the median number of 25 basis point increases in the March SEP was 7. If we were to do a couple of 50 basis point increases as well as those 25s, if you had 9 of those, that would get us after the December meeting to this 2.25 to 2.5 neutral range. So neutral is ahead of us. Okay. I mean, if you're driving from New York to San Francisco, it wouldn't be crazy to talk about, well, I'm headed towards Chicago and I'll see how far I go after that. So, I mean, by December, we're going to get more data on, the micro aspects of the high inflation price increases. How much is broadening out to that 85% that I talked about? If that 4% rate was contained in sort of a first stage to like 3 to 3.5. And then if the other 15%, which went up by 20%, if 5% it came down, that can get you to like a quarter core CPI. Now that would be a very artificial 2.25 because you've still got that 3 to 3.5% for large.
You're sort of taking credit in some ways for the temporary correction there, right?
I object to that term, taking credit. I mean, I don't know if I have to take blame for everything that's gone wrong with semiconductor chips, but if I have to take the blame, I should get the credit. No, I mean, this is just laying out a scenario. The first step would be sort of, some turnaround, further evidence of improvement along the lines of what you suggested, hinted at in the most recent inflation report. Way too early, but if it did, then the second stage would be dealing with that 3 to 3.5%. By that time, we're at neutral. And to the extent we don't see it coming down, we're going beyond neutral. Absolutely. But if it looks like it's sort of, also coming down, that the first round wage effects aren't being passed along, or they're being passed along and then they're settling in, then it could be that, neutral would be about right. Last thing on neutral is there's this, it just gets complicated. I apologize, but there's this unconditional neutral, which I call 2.25 to 2.5. And then there's special factors that take place. And it could be that short-term neutral is actually lower. And by the time we get to 2.5, it's actually more contractionary for a variety of reasons. Can go the other way too.
In terms of the path, you laid out a potential scenario, do a couple 50s first, and then you keep doing 25s. I imagine that obviously is going to depend on how things develop, what you see in the data, and what sort of things. I mean, if we assume that you start off or you get to 50 basis points and then at some point you slow that pace down, what would you be looking for most importantly to tell you, at what point you should you should slow down? Just being higher, being closer to your neutral estimate, what the sequential growth numbers are saying, what the inflation numbers are saying. What would you put most weight on in making that decision?
Obviously, if inflation for some reason began to reaccelerate, I think that would be a cause of great concern. I think that, on a path that included these 9 increases for this year by, December, on the way to December, you'd be looking for any confirmation of the storyline. Like I mentioned, are goods prices improving? Is the shift in consumer and business preference for goods over services, which took place during COVID, is that reverting back? And is that easing the pricing pressures? This is a little counterintuitive for those of us who remember that service price inflation is usually higher than goods inflation, right? But this would be an attribute. Well, we'll have to see how that plays out, right? If the labor force return is going well and people are settling in and business reports are that, things are still able to find workers, that would be a good sign. That would be, then in December, it could be, I have a better sense that, and, probably we are going beyond neutral. I mean, that's my expectation when I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want. If the 2.5% inflation rate, I think we have more things to ponder there. Or if you see signs of slowing economy beyond what we would expect, mortgage rates are high, right? So I would expect that home purchases might, sort of cool down. They're still very hot though. Auto purchases, so there aren't enough vehicles being produced to satisfy all of the demand. People are still paying way above sticker price, right? And it's hard to take possession of a vehicle. You don't even hear things like financing costs or whatever. For the longest time, I've learned that from the auto folks, buyers they like a $500 monthly payment. A large part of the population. If you're going to finance it, $500 your payment. Mortgage rates go down, auto rates go down, you can buy more car. Auto rates go up, you extend the payment period, or you buy less or you stop buying. If we start hearing more about financing, that's probably a sign that policy is having an intended effect and whatnot. But it's going to be monitoring the trajectory of the economy, and then wild cards, of course, are geopolitical issues.
We've spent a little bit of time talking about the path for the funds rate. We haven't spoken at all about the balance sheet. And what the committee has said, of course, is that balance sheet normalization is going to be running more in the background. However, there's been kind of recurrent chatter in the market about potential for using the balance sheet more actively, potentially selling mortgage-backed securities, and do you think that something like that could make sense? What do you think the hurdle is for it, or are you very much in the camp that this is going to be running in the background? It's really the funds rate that we ought to be relying on.
Right. So these are important issues. Our monetary policy tools have definitely expanded, from the 60s and 70s for sure. We're using quantitative easing. When we get the funds rate to zero, we hit the effective lower bound. And, we've learned from our previous experience, QE in 2008 until, 2015 and 17, and all of that. So we've learned useful lessons. Communicating is very important. And there's wide agreement. We just published principles for how we were going to adjust our balance sheet. And the federal funds rate is the primary instrument of monetary policy. It's probably a bit too glib to just sort of say you'd like to get the runoff in the balance sheet on autopilot. Sometimes one of my colleagues said, we want it to be like watching paint dry. You're just watching it happen. That ran into issues in December 2018, and things like that. So, we know that we want to adjust the balance sheet very carefully. So, the most recent minutes indicated that the committee had talked, at some length about letting the balance sheet run off at 95 billion a month, those being the caps. My expectation would be that once we set that and we get up to the pace of 95 billion, we would do that. And it wouldn't be on autopilot because we'd always be looking at conditions that would make us, want to do more, but that would not be an active tool. If the economy needed more restrictiveness or, more accommodation, it would be adjustments in the funds path that we should be doing that. So that's sort of how I see that.
Do you have an estimate of what the balance sheet adjustment equates to in terms of, funds rate hikes? If you say you're getting up to 95 billion per month caps and you let that run for 2 to 3 years, so there's going to be a cumulative, call it 2.5 trillion or, whatever the number is, somewhere thereabouts. Should we think of this as one hike in the funds rate, 3 hikes in the funds rate? Any order of magnitude that you can give us on that?
Well, I think that's the range estimate, sort of, as I've heard people, talk about this. So I think there's a lot of uncertainty about this. then events intervene to make, it very difficult to identify how much actually happened. But, 50 basis points is one number that, has been mentioned by many, and I don't have serious concerns about that. I think the act of letting our, maturing assets roll off by itself communicates that we are embarking on, getting back to more normal situation, and we're letting the funds rate find its appropriate level in order to help facilitate the achievement of our dual mandate objectives.
Wanted to turn to one sort of longer term issue, namely the monetary policy framework, the 2020 framework review, which has come in for some criticism recently in the wake of this inflation overshoot. I mean, one important change was that there was a shift somewhat away from preemptive tightening towards more of a whites of the eyes approach in inflation. I don't know if you think that's a fair characterization, but I think that's the way it looks to many. And do you think that, given the extent of the current inflation overshoot and the broadening of some of the inflation, do you think that that shift might have gone too far?
I think that the framework that we put together recently was a substantial improvement in our otherwise very good framework that was adopted under Chairman Bernanke back in January of 2012. I think that we benefited from being more explicit about what our inflation objective was. There was a time where, we didn't say explicitly what the objective was. I mean, I've been with the Reserve since 91, and it wasn't until 94 that they even made an announcement that the meeting had ended and they took an action. People had to guess what the action was. So I think we made, broad strides and quite a lot of progress. Most recently, we've struggled, in my opinion, I've spoken about this quite a lot. I think the committee struggled mightily to describe and act upon a symmetric inflation objective. I think that when we said 2%, and I think among mainstream central bankers tend to be a conservative lot, if you say 2%, under 2% is just perfectly fine. You want to be close to 2%, but under isn't, over 2%. Well, I don't know. That makes me nervous. How much? 2.1. Oh, I don't even like that. 2.2. Goodness. So I think I do not look at our experience before this and say, yeah, that was symmetric inflation. Oh, sure. I had many colleagues who would be forecasting that inflation is below 2% now, but within 2 years would be at 2%. And then events intervened and we didn't do that. So because of that, you could argue that we've moved the ceiling higher. If the ceiling was 2%, now when we kind of say, well, we want to average 2% over time, but I think in a low interest rate, low R-star environment, this is really challenging. And so we did try to back off of we'll be preemptive. And when we're preemptive, sometimes we see inflation coming and we act, and sometimes we see nothing. We think we see it and it's not coming and we act, and then the economy suffers from that because of the restrictiveness. And so we tried to move that so that we should average 2% inflation over time. Of course, what nobody anticipated was that we were going to see this massive COVID shock, which was going to shut down the global economy, and then starting it again has been very, very hard, and the virus is still around and being dealt with around the globe. And so, as I say, we just saw inflation leap up. And if there's anybody who, in February 2021, when the CPI was 1.7%, and you could see the fiscal support coming, and you talked about overheating, it seems to me all of those arguments were about a progression of inflation, which, then monitoring it and waiting for it to come made sense. If the same arguments had been, there's going to be a supply shock that's going to be dastardly and devious, I'd want to see some evidence, and it would have taken a while, I think. So I think the framework, it's just one of those things where, we were extremely unlucky, the economy and all of that. And I think the framework is still quite sturdy.
And one aspect of the framework, and you touched on it, is, averaging over cycle. And there was a problem with the previous framework, as you said. In practice, it ended up being more asymmetric. But at least in principle, there was always an answer to the question, what would be the ideal inflation rate to be at 2 or 3 years down the road, right? In theory, it was always, you want to get to 2%.
Right.
In the previous framework. Right. Now it's not so clear. Now if you look at 2024, I mean, what would be, if you could just pick a number, right? We know what's happening in the short term. We know this year is going to be, well above 2%. Next year, probably still above 2%. Let's say 2024. If you could just pick a number, what would that number be? Pre-2020, I think the community answer would have been 2%. But I think many of us sort of don't know, do you want to be below 2% because you have to kind of make up for the overshoots, or are you actually happier being a little bit above 2%? Because after all, at some point down the road, probably something is going to happen. There's probably going to be a recession eventually if we haven't had one until then. That's going to get us to lower numbers. So if you can just help me with that, that would be.
Well, those are good observations. And, those are scenarios which could definitely, come to pass. And so the question becomes, what's your intention? I remember, Chairman Bernanke, back when I thought that, we were just, inflation was 2% and we would just work to get it up. And I always thought if all you're doing is to work to glide in 2%, there are too many things that keep you from getting to 2%. Whereas if you're willing to overshoot, then something happens, at least you get 2%. So that's why I thought overshooting was always, part of what symmetric inflation should be. Now, under the new framework, we've said that we should average 2% over time on average. We said that after a period where we had underrun for some time, we should overrun for some time. We did not similarly say that about if we were above 2. So we're not doing price level targeting where we absolutely need below 2%. If for the sake of averaging 2% and getting inflation up, expectations where they should be consistent with 2%, it could be the case that we need to lean harder into restrictive policies. I certainly get that. I think the issues are we want inflation expectations to be consistent with the 2% on average over time, objective. And coming down from above would be, quite acceptable. But with a vibrant labor market, with an economy that's doing really well, again, Bernanke used to be of when things were, really well, you could come down more quickly. If things were not, you'd glide down gently. So I think all of those operational aspects, can still be in place. There's also the unknown, but you can have an idea of this. Just think about fiscal policy. Fiscal policy was a big impetus for, the strong economy and the inflationary pressures, the fact that the supply chain was struggling under so much goods demand. It can also turn around, depending on, what the composition of Congress looks like next year. We've had periods where, we've had gridlock, and gridlock has sometimes been mentioned in a very positive sense, in that regard. But one would guess that would not be the same kind of outsized stimulus that we have seen more recently. And then there are different gradations of that. I think that in 2011, the emphasis on fiscal austerity held back the economy, and we had a very slow recovery because of that. All of those things would be doing part of what you would be expecting, monetary policy restrictiveness. And so, a crystal ball could help there.
I'm going to ask you one last question, and then maybe we can take a couple questions from the audience, if that makes sense. So your former colleague, my former boss, Bill Dudley, was recently out with a strong view that a recession or a hard landing is inevitable within the next couple of within the next few years. I think he had a horizon until 2024. And the inevitable is a big word for a forecaster. But more seriously, where do you see? How worried are you that, in part because monetary policy needs to respond to inflation that is much higher than we all want, that we're, sowing the, laying the groundwork for a recession before too long?
Well, I think, this is going to depend on, how things play out. That's why my own view is that even with more front loading of our policy increases than the SEP median displayed in March, by the end of the year, if we get to 2.25 to 2.5, we're going to be able to look at what the state of the economy is. And is it starting to show signs of stress already from those actions? Or is it off? Is the unemployment rate going down to 3% on its way down to 2.5%? And by itself, that's a good, not a bad thing. But if it's still the inflation pressures are very high, it probably means we'd have to do more. And then it would be more challenging. Obviously, there seems to be a regularity that, when the unemployment rate starts going up by any meaningful amount, it usually ends up continuing to go up and is a recession. Doesn't have to work out that way, but it seems the case. And I know that Bill has argued that type of correlation for quite a long time. And so that probably is part of what he's thinking about. But I think that we have optionality as we are still okay to raise rates at the pace that we're talking about, and we'd be able to make adjustments if necessary.
Great, thank you so much. Maybe we'll take a few questions. Maybe starting right here.
So there are two things which there are two things which are mystifying markets and investors, and a concern around credit, which sort of falls out of them. So the first is that I think the feeling that the equity markets are defying gravity in the face of, perhaps growth slowing and all of the effects you mentioned, inflation and the hiking path. And then the second is that the long-term forwards in the bond market are still well below your projections, and that real yields are either negative or have been persistently low. And then you've got your balance sheet runoff, which I guess we're all worried might affect the provision of credit. And so, how do you put all of those things together? I'm sorry, there are so many parts to that, but how do you put all of those things together?
Well, I think the balance sheet runoff is something, markets have become adjusted to our purchases, and, now they're probably going to struggle with the runoff. The private sector is going to have to absorb more of these assets, and that could crowd out other types of, funding opportunities. I just think that's inevitable, and that's what markets are going to have to, get used to. Now that always makes me nervous because at some point, policymakers usually go, well, this is the way it's going to go, and this is why it's like monitoring. I think is really very important. Equity valuations, I really don't have any, thing to add there. I think that there are just so many fundamentals that have been at work. Tax reform, has altered things. I think the composition of, the sort of the high tech, goods production and aspects of that. I just don't do that for a living. But, there are a lot of different things at play. And then obviously the way the bond market is looking at the future. Again, with the expectation and hope that inflation is going to start coming down, some component of it is going to start coming down. You look at some of these, 5-year ahead, projections, and if you take out the first year of inflation and look forward beyond that, it's lower. 2 years, it's even lower. So, I just think that's sort of consistent with the way so many of us are looking at the dynamics of the price evolution. That could be wrong. And it could be wrong for a continuation of all of the supply problems that we've seen, the Russian invasion of Ukraine, the Shanghai lockdown, the ports in Shanghai looking like the ports of Los Angeles, probably worse, and all of that, and how that out things that I expect to show improvement in the supply chain might take longer, could get worse. So it's just really hard to assess that. And yet levels still seem to be high. Maybe that's the right place.
Back there, please.
Thank you so much. My name is Tara Hariharan, and I'm actually a 2022 fellow of the Economic Club. Very glad to be here.
Super.
My question regards how much monetary policy can actually deal with inflation if it's coming from supply side and energy related issues. I know the US has, of course, much more pervasive core inflation, maybe not the issue that the ECB has, where it's very much energy related headline inflation. But I would just be interested in your broad views as to how much monetary policy really can bring down oil and inflation expectation related to oil prices.
Well, I think you're right that, when you see these real side factors, giving rise to relative price increases for things like energy, very scarce parts of production and things like that, that just shows up in our measured inflation data. So, so then, standard is to sort of, those special factors, I don't want to take them out forever, but, look at what's underlying that. And so when I look at that, I still see 4% inflation or, too much of the basket. The problem remains and is probably likely to persist, without getting monetary policy right. But can those technology features lead to ever increasing prices? I mean, that's, that would be worrisome, but it would still be an industry real study. And then innovation being what it is, businesses find ways to, change production to, on that as best they can. Now, you can't just all of a sudden change your natural gas delivery from, Russia to Europe and, more equivalents of that, but it could take time. But basically, I keep coming back to usually the industrial story, there's sort of a limit and there's a relative price that's being sought by the markets. But once it gets to that, it really should keep going up at like the rate of inflation. That's the monetary aspect of it. But the longer it persists, the less faith you have in that. And it doesn't make you comfortable with a very low setting for monetary policy. And so that's why I think there's this, natural adjustment. And, a year from now, I think that we're going to have very different conversations. They're either going to be louder or they could be quieter on the way up or something entirely different.
One more question? We can take one more, right?
Yeah. There hasn't been much discussion of the velocity of money in all what I've been hearing generally, and yet it can be a major factor that impacts what adjustments in the monetary base are going to have on the economy. Could you discuss velocity?
Well, I mean, velocity is, the fundamental belief of monetarism and, the equation of exchange is that velocity is constant, that, money demand is stable. And so, prices times quantity equals money times velocity. Velocity is being constant. Then I can look at money growth. Then that tells me all I need to know about how to break that down. Velocity just has been unstable for decades and decades, which means that I don't know how to control for looking at liquidity and, other things like that. Even if velocity were to sort of settle down, and this is the financial innovation over a long period of time. If it sort of settled down, I still wouldn't quite know what to do with it since I don't have a track record of, then I'd have to build a track record of what that really means for inflation. But I think, in terms of, liquidity concerns now in our balance sheet, you could be looking at the growth of our balance sheet and kind of go, I can't tell you what monetary aggregate I should look at, but this is explosive. I've seen enough. But then we turned it around And the kind of analysis in economic models is that turnaround's fundamental. If ultimately you end up in a spot that isn't this explosive monetary part, then with rational expectation, you shouldn't really price in too much of permanence there. So I kind of look at it that way.
Thank you both. This was terrific. A great conversation. Really wonderful. So we hope everyone enjoyed being together today. And as I said, we hope the over 100 that we have online also enjoyed the virtual experience. We're pleased to share that we have a number of additional prominent speakers added to the calendar this spring, starting with tomorrow. We have Brian Deese, Director of the White House National Economic Council, and will be here for that. General David Petraeus will be talking about the situation in Ukraine, the former director of the CIA, and that'll be virtual April 25th. Jamie Leverton, the CEO of Hut 8 Mining Corp., and that's mining as in crypto currency mining, will be May 3rd. That too will be virtual. We have Dana Suskind, a professor of surgery and pediatrics from University of Chicago Medicine on May the 9th. That'll be virtual, talking about a new book. John Rogers, the chairman and co-CEO of Ariel Investments, will be joining us in person for a hybrid event May the 16th. Followed by Tony James, the chair of Jefferson River Capital. That will be virtual on May the 24th. Arvind Krishna, the chair and CEO of IBM, will be joining us for in-person, a hybrid event on June the 7th. And Brian Cornell, we're pleased, is going to be joining us, the CEO of Target, June the 21st. And that will also be an in-person hybrid event. So plenty of events coming up. I'd also like to take a moment to recognize those of our 345 members of the Centennial Society joining us today. Their contributions continue to help to make our programming possible. And finally, as a reminder for all club members, you'll receive an emailed post-event survey today. We hope you'll take a moment to fill that out, as we're always looking to improve our value proposition for our members and their guests. So again, thank you all for attending. And for those of you in the room, please enjoy your lunch. And we look forward to seeing you again soon. Thank you, gentlemen.
Thank you.